Meta is trading at $747 a share, just 6% away from its all-time high. And investors are naturally asking themselves, can Meta stock continue to skyrocket? Well, here's the wild part. Analysts think it could run up another 46%, all the way to $1,086. My name is Rick Orford. I've been trading since 1999, and no, I'm not a financial advisor, and that's a good thing because it means I'm not here to sell you some retirement package or a flashy course. I don't do hype, I don't do numbers. And the numbers on Meta, they're insane. Revenue, up 21%. Profits, up 36%. And operating margins, 43%, meaning Meta keeps almost half of every dollar they make. But here's the catch. Mark Zuckerberg just committed tens of billions of dollars to build the largest AI data centers on the planet, Prometheus and Hyperion. And if he's right, this could cement Meta as the AI backbone of the future. If he's wrong, this could be his last trillion-dollar bet. Stick with me to the end, because I'm going to break down Meta's growth, risks, and whether I think the stock still has gas in the tank, or if the AI dream could turn into the next metaverse flop. Meta Platforms is a global force at the intersection of social media, digital advertising, AI, and immersive tech. And here's the thing. Few companies on Earth touch as many lives every single day. Facebook may be the flagship, but Meta's ecosystem also includes Instagram, WhatsApp, Threads, and Reality Labs, all linking billions of people globally. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/RickO to get your 10 stock picks right now. Its key revenue driver remains advertising, especially Reels, which is projected to generate 50% of the American ad sales. What makes Meta stand out is its ability to adapt and scale. It builds platforms people can't stop using. And for proof of that, you only need to think back in the first few years of Facebook. And that's the same habit loop that's alive today. And it's what keeps advertisers paying up. At the same time, the company is pushing forward in AI, virtual reality, and augmented reality. In many ways, Meta isn't just shaping how we communicate today, it's shaping how we communicate in the future. It's also laying the foundation for the digital worlds of tomorrow. So you could say that Meta isn't playing checkers. It's quietly building the chessboard for the next decade. And of course, analysts haven't been sleeping on the stock. Currently, Meta has an overwhelmingly strong buy rating among 55 analysts with a high price target of $1,086. That means Wall Street sees as much as 50% upside from here. But do they know something that retail investors don't? Let's find out. Meta just released its second quarter financials, and it caught the attention of many investors. And I'm going to talk more about that later, but let's just say that its reports beat everyone's expectations, except maybe Zuckerberg's, right? Meta stole the headlines after its CEO, Mark Zuckerberg, disclosed that Meta will invest hundreds of billions of dollars to build massive AI data centers, starting with a multi-gigawatt Prometheus facility that's expected to be online in 2026, and scaling to a 5-gigawatt Hyperion cluster. If Meta delivers according to its plan, it would significantly push the field of AI, and that means increased investments and trust. Meta isn't just betting on the future, it's trying to own the infrastructure of the future. All right, let's shift gears a moment and talk about something that every investor, I think, should care about, the stock price. And if you want to follow along, just scan this QR code. At the time of recording, the stock price is just over $747, off just 6% of its recent all-time high of $796.25. Meta is also up 40% over the last 52 weeks. It even surpassed most of its peers in the Magnificent Seven, trailing only Tesla. And if you're keeping score, that's a tough group to beat. So despite a minor pullback recently, Meta is still up by a decent margin. The big question is, though, does it still have gas in the tank? Well, to answer that, we need to start by looking at the financials. The company's second quarter financials for 2025 highlighted a 21.6% increase in revenue and another 36.2% improvement in their bottom line. Profitability also strengthened, with operating margins expanding to 43% from 38% just a year ago. That basically means that Meta is keeping more money from every dollar they bring in. Think about it this way. Meta is now turning almost half of its revenue into pure profit. That is elite territory. It also makes its dividend program more sustainable for investors, and I'll talk more about that later. Historically, Meta, of course, has performed very well, but the question is, can it continue? The short answer, I think, is yes, because the scale of what Meta is building is what most investors underestimate. The biggest factor would be Meta's accelerated AI infrastructure investments, which puts the company at the forefront of AI innovation. Meta increased its 2025 capex guidance from $66 to $72 billion, which signals a substantial ramp-up from its prior commitment. The company expects another year of similar capex growth in 2026 to support its AI infrastructure expansion. That's more than the GDP of some countries, but I digress. Specifically, these investments go into projects such as the Prometheus supercluster in Ohio, which is built to accelerate AI model training at massive scale. And then there's also the Hyperion cluster in Louisiana, a data center campus the size of Manhattan that will handle next-generation AI workloads. Imagine a data center so large it rivals an entire city. And that's the level that Meta is playing at. It also supports the build-out of high-performance compute, new data centers, and Meta's superintelligence labs, which are all focused on advancing the frontier of AI research. And this is a question that comes up a lot on my Discord channel. How long can Meta keep funding super AI without hurting profits? Well, think about how you check Instagram or Facebook. You might only tell yourself it's just a minute or 2 or 5 every day, but suddenly 20 minutes have gone by. And that's the strength of habit. Meta's ad engine works the same way. Even as AI develops, advertisers keep pouring money into the platforms that people can't stop using. And that's the kicker. That habit loop is what makes those billions in dollars in AI spending a little less risky than it looks. Now, before you think Meta is unstoppable, let's step on the brakes a second, because the risks, they're also very real. Like many big companies, Meta faces regulatory scrutiny. However, Meta's case is a bit more peculiar. Authorities have launched a probe after recent reports that its AI chatbots could engage in inappropriate conversations with minors, which is obviously unacceptable. Since August, lawmakers have pushed for internal documents on training, deployment, and child safety safeguards. And if regulators make an example out of Meta, well, the fallout could hit both reputation and revenue. Meta could face fines, stricter AI rules, product limits, reputational harm, and tougher oversight, which altogether could lead to restrictions on future innovation. And this territory is tough to navigate. One regulatory slip-up today could slow down years of innovation overnight. Second is Meta's decision to spend between $66 and $72 billion. Sure, you could say it's a big number with lots of possibilities, but it also raises concerns given the history of its past big bets, like Metaverse, that have yet to deliver any strong returns. Its aggressive push in the AI industry leaves zero margin for error. In the very worst of scenarios, this wave of AI infrastructure spending could be Meta's last major shot at sustaining long-term growth and investor confidence. And that's why investors see Meta as a genius move, while others see it kind of like rolling the dice. Now, with all of the external factors out of the way, let's talk about Meta's valuation. Meta trades at a forward price to earnings of around 27.4 and a forward price to sales of around 11.7. And these ratios indicate that the market anticipates continued growth without the stock being overvalued, especially given the company's strong profitability and their high return on equity. In other words, the market is pricing Meta for growth, but not at nosebleed levels, right? Compared with its industry peers in the Magnificent Seven, Microsoft, for example, trades at 34 times forward earnings, and Amazon also at 34.5. And then we have NVIDIA. They're far higher, at almost 45 times forward earnings, with a price-to-sales ratio of above 34. And of course, the outlier here is Tesla, with a 279 forward PE, but that's for another story. Side by side with these giants, we can say that Meta's multiples are more modest, giving it a balance of growth potential and risk. And that is a rare sweet spot, right? Growth stock upside, but not at growth stocks pricing. And it's this that makes Meta one of the more reasonably priced names in the Magnificent Seven, while still offering solid exposure to AI growth. So the big question now is, do you believe that Meta can execute? Because the valuation says Wall Street thinks so. If you're an investor who strongly believes in artificial intelligence and ad growth, well, Meta could be a perfect addition to your portfolio. Aside from Meta's momentum and leadership in AI, what stands out to me is its recent decision to start paying dividends. Today, its forward annual dividend is $2.10 a share, and that translates to a modest yield of 0.27%. Sure, the yield is low compared to other dividend stocks, but the combination of dividend initiation, strong cash flows, and AI-driven growth gives me the conviction that Meta can be a long-term compounder. So you could say this: Meta may not pay you much today, but it's definitely setting you up for tomorrow. So here's my question to you. Are you betting on Meta's future, or do you think that execution might fall short in 2025? Let me know in the comments below. And while you're there, if you found this video helpful, do consider giving it a like and subscribe to the channel so others can find it as well. In the meantime, I wanted to thank you so much for watching, and I'll see you next time.